Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's June 29th. We got some important economic news releases to go over today, so we're going to jump right into it. And we'll start off with the weekly jobless claim. So last week we had 242,000 people apply for unemployment. This week the forecast was supposed to be at 243, and it came out at 244. So a little bit more. We've seen it kind of inching up a little bit, but still, these are very good numbers here. Nothing to be worried about. We're still seeing good job numbers thus far. Historically speaking, these are great numbers. And last but not least, we got the important one here is our first quarter GDP. This is the final revision here. So the last revision we had, the second revision, was at 1.2% for the first quarter. And forecast for this, the final was at 1.2, and it jumped up to 1.4. So obviously we like to see the improvement, but again, it's still very low here. So these are pretty low numbers here. Now, interestingly enough, the Atlanta Fed gave a forecast back in May that they think the second quarter will be at 4%. Just recently, they just came in with another revision of that estimate at 2.9%. So that's a pretty big drop here. Now, a lot of the data we're seeing so far is we're seeing some slowing down in a lot of different areas. Even inflation's pulled back quite a bit. We went from a high of 1.8 on our core PCE, core inflation, what we look at, and now it's down to about 1.5%. So these are things hopefully the Fed will be watching. Right now they've been kind of saying it's a temporary blip and it'll go up, and probably reach our target, probably sometime next year. But again, these rate hikes typically takes about 6 months for the market to absorb it, and if it's absorbing these latest rate hikes, it could be slowing things down a lot further, maybe more than they initially thought. So let's take a look here at the headline news. The stock market's down quite a bit, actually. The Dow and Nasdaq are down both over 100 points so far this morning. A lot of it is being weighted by the technology. Now, we've had a lot of comments this week with a couple of banks. We had the ECB with Draghi a couple of days ago. I believe it was on Monday or Tuesday. And then we had Bank of England and Bank of Canada, all basically saying that basically they're going to probably be a little less accommodative. Not so much that they're going to mess things up, but they're giving a little bit more hawkish stance, saying that they're probably not going to be buying as much of these mortgage-backed securities, like these what we were doing before, where we're buying up a lot of things and keeping rates artificially low. So right now they're basically saying that this is kind of ending right now, and they feel things are improving in their areas. From Canada, England, as well as the ECB, or in Europe. So, they're kind of watching it, and again, inflation's been under control. But today, speaking of inflation, Germany came up a lot higher than they expected. So that kind of also spooking the markets over there. Then later today, we got some Fed speakers giving speeches. So anytime they speak, of course, the markets listen and could make it a little bit more volatile. So always be cautious when Fed speakers are out there, because we want to hear what their insights are. But yet, we're trying to get some clarity. And right now, it looks like from the different speakers we're getting a lot of different messages. So it's going to create a lot of uncertainty with the investors, and we'll probably see some safety. So let's take a look at the bond market. So as you can see, we're starting to kind of see more of a pattern here, this downward trend. I'd be very cautious right now what's going on here. One of the things that we're kind of seeing is some of the, with the bond prices going down, we're starting to see yields rise. Now, because we had the yields rise as low as at 2.11, now they're up to about 2.28 right now. We're starting to see that. Remember, we've been talking about this death cross for about a week now, and right now, because of that rise, is looks like it could either offset the potential cross, or maybe not happen anytime soon. So be cautious. We may not get that death cross because of a lot of the news abroad here. That's what's really kind of spooking the bond markets and the treasuries. What's affecting those is those hawkish comments made by the ECB, the Bank of England, we just discussed, and Canada, but especially Draghi's comments earlier. And this is what's so those global effects are kind of affecting us more here at home in terms of the treasuries and yields, treasuries and yields here. So again, 10-year Treasury is up to about 2.28, but right now we're starting to see the mortgage-backed securities drop, which basically means that rates are going up. Right now we're down currently about 19 basis points from where we left here. Now we're about right here. Oops, sorry about that. So basically that's where we're at right now, and again that translates to higher rates today. All right, folks, that pretty much does conclude it here. So we'll go back to that other page I actually clicked on here, but if you guys want more updates, just come over to Twitter. I do a post up there. Find me underneath Mike Bjork on Twitter. And again, if you guys are looking for any mortgages, I am a loan originator. I can assist you with your purchases, with the pre-approvals, and helping you buy that next property, to refinances for those who want to take money out of their equity of the property, like a cash out refinance, to people who want to go from adjustable rates to fixed rate, to those who want to go from a 30-year to a 15-year. Those are some of the different things we're currently working on with other clients right now. So just feel free to reach out, and we'll help you out as best we can. You guys have a great day. Thanks so much for watching. I look forward to seeing you guys tomorrow.